Welcome back, everybody. This is Johnny. I'm going to show you a fairly quick tutorial on how to make passive income using options with a high probability of success. So without further ado, let's get started. They're called weeklies, and what I mean by weeklies is you're purchasing an option that expires in a week. So the idea is we want to have something expire worthless so we get to keep the premium. What I mean by that, let's go down to some of the stocks that will give us the biggest premium. So let's say Google, for instance. We'll go down to trade options, and because the long Labor Day weekend, I'm going to go September 7th is when I want it to expire. And it depends on what kind of a position I think this is going to be. Do I think Google is going to stay the same? Do I think it's going to go up? I think it's going to go down? Let's just say we have a neutral position. Okay, let's just, for the sake of it, let's just say, in the next week, I think Google is going to stay at $1,234.35. So I want to put on an iron condor. What I mean by that is I'm going to buy a put spread and I'm going to buy a call spread. A put spread is here in, well, actually I'm in the calls, is shorting the stock, and then a call spread is going long the stock. Okay, so I always like to start with my puts. So what you want to do is you want to sell one put and then buy another one, because we don't want a naked option, because let's just say, all right, I'm going to sell one put at $1,227.05. Watch what happens. Ooh, okay, I've got to update it. Yeah, I'm going to receive $990 if it doesn't reach this price. That is amazing, right? Like, there's $1,000 you can make passively right there. But boom, I need to deposit $122,252.19. Reason being is, in case that gets down to this price, I have an obligation to sell 100 shares. Well, I can't afford 100 shares at $1,227.05. So what we do is we would hit this select button up here. So we'd go select, we'd select that same option, boom, and then we'd go over to buy. So we're going to buy one so that we're offsetting. Does that make sense? You're selling 100 shares, you're buying an option for 100 shares too, so it equals out. So I'm going to go the lower one right here. So, you know, I sold this 127, or excuse me, 1,227. Now I'm going to buy the 1,225. And you can see I get to keep the difference. So it's going to be a $100 difference here. So then if I go down to options, you can see I'm collecting credit of $1. So if Google does not go below 1,225 by September 7th, I am going to collect $100. Actually, it can't go below 1,227 because then I'd be assigned the 100 shares. So it can't go below there. So I've got, you know, $6 or so to play with. And again, I'm thinking it's neutral. So what I would do next is I'd go to the call and I'd sell a call. And I'm going to go right around the same delta. And I'm going to pick this one, 1,240. And it's saying I've got a 69% chance of profit. It's a fairly decent chance. And then what's the next thing I got to do? Well, you guys guessed it. I got to buy. and I'm going to buy the one above now. All right, not the one below. I'm going to buy the one above. So again, I get to keep the difference here, which is about, what is that, $90? So then now I've got a range, right? I've got a range of from this 127.50 to this, I keep saying that wrong, guys, 1,227.50 cents to this 1,240, and it's currently trading at the 1,234 mark. So, you know, if it stays within that range, I get to collect the premium of $190, which is pretty good for 1 week, right? So we've got 190 right now that we can make during this week. Here, so that I can help you guys out. Let me do that again, because you're gonna need some sort of buying power, which is just a little bit of collateral, which is the mask. What did I pick? I picked 227. Here. All right, I'm back. So there's the 190, right? So here's I'm collecting 190. Now I've got to have a little bit wider of a spread. Well, I still want it to be 190. And I only need collateral $250. That is an amazing risk to versus reward ratio. So the max I could lose is $250. The max I can gain is 190. Okay, that to me sounds like an easy $190. I wouldn't say easy, but potentially 70% chance of profit to make $290. So here I'm just gonna go 250 because that's theoretically our max loss right now. But again, this is not gambling. I've got a 70% chance of it being somewhere in my strike zone. So let's keep going. And you know, if I wanted to, I could say 2. I want 2 iron condors. Yeah, so, you know, I'd need minimum of 500 and so on and so forth. But then I'd be getting 380 and blah, 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 blah. That, to me, pretty good deal. Let's just say I wanted 10. Well, I'm going to make $1,900 off $2,500, right? That's pretty good. So if you have $2,500 in your account and said, hey, I wanted to put it on this weekly, I'm going to receive $1,900 if it stays within this range. That to me is pretty good risk versus reward ratio. So let's just say we wanted to do just the one contract for Google. So that's what we have, the one iron condor. And then let's say Amazon. Man, Amazon has just been going higher and higher and higher. It's kind of a parabolic move, in my opinion. So there's going to be, it looked to me like it was being overbought yesterday on Friday. So I am just, theoretically, we're just doing this just to see what happens, is so my assumption is I think Amazon is going to go below $2,016. And just to be safe, I want to have a call credit spread, which is a bearish move. So what I'm going to do is I'm going to sell the 2020 call, and I'm going to buy the 2022.50 call. So what does that look like? Select, I am selling the 2020, and then I am buying the 2022.50. And you can see this one is $1,643. This one is $1,758. So I get to collect total credit. It says call credit spread. I'm collecting the $1.15, which is actually $115. So I want one of those suckers. It's going to say my limit price. It's trading between 0 and 230. I'm receiving a credit. And I want to receive 115. Boom. So again, 115 to make, or risking 250. And again, let's just say I had $2,500 that I wanted to put up for collateral, not just the one contract. Then I'd be making $1,150. Boom. Right there. But for this short video, let's just say one. Well, I'm already at 13 minutes here. So I'm risking another 250 and I'm gaining 115. All right. What's another one? And see, you could play with all these. Like, oh, you know what? Tesla. September 7th, I think Tesla is going to go down. So, actually, let's do one that I think is going to go up. So that we can boom, 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 do there. Let's do Alibaba. So I'm going to go trade options. So then that way I showed you 3 different option trades on making money, risking very little. I'm going to do September 7th. And since I'm bullish, guys, so bullish means it's going up, wanting it to go not to the moon. To the moon would be nice, but anyway, I'm saying that it's going to stay above whatever my strike price is. So let's go down. I'm going to sell or purchase a bull credit put spread. All right, because puts are shorting. I'm trying not to confuse you. Just follow along again. 1,000-foot view here. Let's stay around that 70-80% chance of profit here. So let's go with this guy right here, 172.50. I don't think that Alibaba is going to go below 172.50 cents by expiration of September 7th. So I am going to go select. I'm going to sell that guy. And what am I going to do, guys? What's my next step? Buy. Which one am I going to buy? Because again, I'm trying to keep the credit difference of the different prices. I could go down here. I could go here. I could keep going here. But I'd have put up more collateral. So here, I'm just going to go to this one. And I get to keep the collateral if it stays above this 172.50 by September 7th. Again, forgive the repetition. I'm just doing this to try to help. So, boom. I'm going to collect a credit of $61. I'm going to go review. I want one of those suckers. Gonna boom. And so this guy, I still need $250 for collateral, and I'm only making 61. So the Google, and they're a better bang for your buck right there. But here we go. So plus another 250 is the money I need to make these trades, and I'm gonna collect another $61. So I would probably put on the other trades, but this one still might be a potential as well, because you know I'm risking 5 to make 1. You know, the other ones it's almost a 1-to-2 ratio, which is nice. So even some of them, even the Google one was less than it was almost a 1-to-1 ratio as far as what I was risking versus reward. But you can see I can make easily $1,000 a week using options and having a very minimal collateral in my account to do so with commission-free options. So if you guys want more info, I've got more videos, which would be awesome. Check them out. And if you need some more help, obviously do the comments below. I try to respond as soon as I can. And if you want to use Robinhood, well, I've got a link below that you can sign up, get a free stock. You could sell that stock because it could be an Apple stock, it could be a Sprint stock. So you could sell it for anywhere between $5 to $250, and then boom, you could put on one of these trades just for signing up using my link. So thanks, guys. Take care. This is Johnny. Bye.
And now I know my heart is a gold.